Why would clients who are in a high tax bracket today perhaps be in a lower tax bracket in retirement? What kind of things might clients do in retirement to change the nature of their income?
Well, they may not have wages or income from a trade or business. Probably tax rates aren't going down in the future, or that's what we anticipate. But I think it's more their active income, wages, so forth from businesses.
Okay, and I think a lot of clients tend to be a little bit more conservative in their retirement years with their investments with things like municipal bonds that may create tax-free income.
That's absolutely true.
And currently there's a favorable tax rate for capital gains, so to the extent that they have long-term capital gains, the rate would also be lower, correct?
Correct.
Now, does it matter when performing this calculus as to whether a conversion makes sense or not, where the client lives at all?
Absolutely. If you live in states like New York or New Jersey with a state income tax as well as a federal tax, it may make the conversion equation a lot harder to figure out. Many clients move to Florida in retirement, for example, and thus would avoid state income taxes. So looking at your state residency is certainly an issue.
So if a client's considering that in the future they may live in a state like Florida or Arizona, some state without an income tax when they're in retirement, that may mean that they're paying less overall taxes if they keep a traditional IRA and they don't convert.
That's right, Jeff.
Very good. Does it matter at all where their beneficiaries may live? For example, if we have clients who have already moved to Florida, they're in their retirement years, perhaps they're even making withdrawals from a traditional IRA right now, but the beneficiaries of those accounts upon their death are active participants in jobs or earning perhaps in the top tax brackets and live in states like New York, New Jersey, or other high income tax states, would that perhaps change the calculation?
Well, I think that would make the Roth more favorable, because when those beneficiaries of the Roth IRA receive the Roth upon the owner's passing, then they'll receive an inheritance that is income tax free. Certainly not estate tax free, but income tax free.
And by income tax free, you also mean tax free from a state income tax perspective, correct?
Yes, from state and federal.
Excellent. Now, it's also true that Roths might have impacts on estate planning, which is my specialty, Marjorie, as you know. For clients thinking of converting, one of the issues that we would consider is that because of the lack of required minimum distributions during their lifetimes, and assuming that they were able to pay the tax on the conversion with non-IRA assets, it's quite likely that the Roth IRA would grow to be much larger upon their deaths if they live to life expectancy than their traditional IRA might be. This could lead to a preference for perhaps changing the beneficiary designations in Roth IRAs to use trusts as vehicles to protect the inheritance for a client's children or even grandchildren one day. Given the tax-free withdrawals, using trusts as a beneficiary of a Roth IRA may be much more valuable than using them in a traditional IRA. Of course, that's a tricky area, and some advisors will need to take a look at just what the rules are, but I assume when clients work with advisors like yourselves, we consider the tax consequences of trust beneficiaries as part of the planning.
Jeff, can you tell me a little more about donor-advised funds and how they can be used to offset the income reported as a result of a Roth IRA conversion?
Absolutely. A donor-advised fund is a fund created through an institution like the Community Foundation for Palm Beach and Martin counties, where you make a substantial contribution to the foundation today. The entire contribution is deductible. It's also a donation to a public charity. And the client can then enter an agreement with the Community Foundation that would allow the client to direct over the lifetime of the client or even into the future after the client's death how the funds in that donor advised fund will then be distributed. For example, I could have the discretion to distribute to any charities that I'm interested in supporting. I could ask the Community Foundation to make distributions from my family fund to those causes, and I could direct that when I'm gone, if there's any money left over in my donor advised fund, that my children have the right to continue to make that direction.
Yeah, these are wonderful vehicles, and you can direct where the funds are going through the Community Foundation without the cost of a private foundation where you'd have the same type of authority, but without the cost of setting up a private foundation and obtaining your exemption and filing tax returns and so forth.
Absolutely. You could save money in the formation as well as every year in the annual management of this fund. Marjorie, charitable giving in connection with Roth conversions is a very powerful opportunity that many clients should consider.
I agree, Jeff, and certainly you want to speak with your tax advisor to determine just the amount of charitable deduction that you can absorb as a result of making the Roth conversion and your other income. You certainly want to remember that you can get a charitable deduction only if up to 50% of your adjusted gross income if you are contributing to a public charity, and in addition you do have phase out of your overall itemized deductions.
And the Community Foundation is a public charity, right, Marjorie?
That is correct, Jeff. Are there any other charitable techniques to consider?
Well, there's one other technique that might be particularly valuable to clients making Roth conversions this year, and that's the charitable lead trust. Marjorie, as you know, a charitable lead trust is an irrevocable trust that a client funds with assets, and they're entitled to take an income tax deduction in the year of the funding as long as they become liable for the income tax during the trust term. They can that way lump a substantial charitable income tax deduction into the year of the Roth conversion, and then over the lifetime of the trust, they can recognize the income, and ultimately, if there are any assets left after the trust term ends, it will benefit their family. During the term of the trust, let's say we did a 20-year charitable lead trust, we might make a payment to the Community Foundation for a client's donor-advised fund. If there's enough annual distributions, the present value of which might be 100% of the money contributed, we could take a charitable deduction of 100% of the trust value. Ultimately, we're doing a lot of good for charity with the charitable lead trust, and if there's money left over, we have the chance to leave a substantial inheritance for the family. So we're doing both philanthropic good, we're doing some income tax planning, and ultimately some potential gift in estate tax planning by leaving inheritance for the children.
Now, Jeff, you just spoke about a charitable lead. Why don't you describe a charitable remainder trust?
Well, a charitable remainder trust, Marjorie, works in the opposite direction, where we fund an irrevocable trust for the client, and the trust makes a payment back to the client, typically, or the client and a spouse, for a term of years or for a lifetime. And at the end of that term, whatever's left over passes to a charity like the Community Foundation. You would then take a deduction for the present value of the future payment to the charity. For example, if it was a life expectancy table we applied, or if it was a term of year, we'd present value the provisions for the client. We'd reduce that from the amount donated to the trust, and the rest would be deductible.
Very good. So both a charitable lead and a charitable remainder, you can receive current income tax deductions if you'd like to use the trust arrangement and benefit potential heirs. In addition, you can make a current contribution and offset that Roth IRA income. Well, Jeff, it's been a pleasure to talk with you about Roth IRAs, and we appreciate the opportunity that the Community Foundation has given us to speak with you today.
The pleasure's mine. Thank you, Marjorie.